do expect the Federal Reserve to ease policy in 2023, but not because of a victory in the war against inflation. No, they're going to surrender. Inflation is going to win that war. The Fed's going to run to fight another battle. At least it's going to try to fight, because it's going to lose that battle too. And that battle is going to be recession, maybe financial crisis, maybe a battle to try to prop up the U.S. government. The index is now up 1.7% so far in 2023. It's bringing up the rear of the major indexes. The S&P 500 doing a bit better, up 2.1%, and the NASDAQ is up 2.5%. The leader is the Russell 2000, which is up 3.5% on the year. Now, one of the reasons that you're seeing more strength in the S&P than in the Dow is we have gotten a bid in some of the beaten down stocks, but the fact that those types of stocks are the ones that are leading the rally, basically the most overvalued, heavily shorted names are the ones that are rallying. To me, that indicates the unsustainable nature of the current rally, when all you have is short covering and maybe some speculators trying to get in for a quick buck and ride these stocks up. For example, the Cathie Wood ARK Innovation ETF is up 7.6% so far this year. That likely means that when the momentum runs out and then in fact turns, that these stocks are going to come crashing down for new lows and likely take the major indexes down with them. But a continuation of the trend from last year, foreign markets are outperforming. Foreign stock markets are doing better than the S&P 500. And in fact, the best performing stocks of all are the gold stocks. That continues. The GDX, as I'm recording this podcast after the market closed on Tuesday, is up 11% on the year. The GDXJ, which is the junior miners, is up a little bit more, up 11.3%. Gold itself is up 3% so far in 2023. It closed Tuesday at about 1788. That's a 3% gain on the year. That's better than the S&P 500 or the NASDAQ. It's only lagging the Russell 2000. But if gold and gold stocks are the top performers, that doesn't indicate that you have a healthy market. And in fact, maybe we're going to get a reality check on Thursday when we get the release of the December CPI. That will be the last read on domestic inflation for 2022. And there is some continued optimism that we're not going to get much in the way of inflation. The expectation is for an unchanged reading during the month for the headline number, and the core ex food and energy is supposed to rise by 0.3. The year-over-year rise in the CPI is supposed to come down from 7.1 in November to 6.6 in December, and ex food and energy is supposed to drop from 6.0 in November to 5.7. Now, if we don't get that type of reduction in the official inflation numbers, that could send the market into a tailspin, because everybody is hanging their hat on the fact that inflation is going to come down in 2023. And because inflation is going to come down, the Fed is not going to have to be as aggressive as many people suspect. The Fed will be able to ease up on the rate hikes. And in fact, if enough progress is made on inflation, many people expect the Fed to reverse course and begin cutting interest rates before the end of the year. Now, I agree with that camp. I think there is a good chance that the Fed will cut rates. In fact, there's probably an even better chance that they will go back to quantitative easing, whether they cut rates or not. But I do expect the Federal Reserve to ease policy in 2023, but not because of a victory in the war against inflation. No, they're going to surrender. Inflation is going to win that war. The Fed's going to run to fight another battle. At least it's going to try to fight, because it's going to lose that battle too. And that battle is going to be recession, maybe financial crisis, maybe a battle to try to prop up the U.S. government, whose insolvency is becoming a bigger problem with rising interest rates. In fact, I looked up on the national debt clock, and as of right now, the national debt is about to hit 31.5 trillion. In fact, by the time a lot of people listen to this podcast, it will be over 31.5 trillion. And that number is getting bigger and bigger, but the cost of financing that debt is getting bigger and bigger because of the rate hikes. Not only the rate hikes that we've already had, but the rate hikes that are going to come. And because servicing this debt is going to become so problematic in 2023, that's another reason that the Federal Reserve is going to back off of its rate hikes and, in fact, may have to go back to quantitative easing because they will need to buy treasuries that private buyers don't want at interest rates that the U.S. government can't afford. But while I'm on the topic of credit and debt, we got the consumer credit numbers for the month of November that were released yesterday. And we had another huge increase in credit card debt in particular. Total credit card debt is now $925 billion, or at least it was at the end of November. And that's just $2 billion below the all-time record high, which was set in the fourth quarter of 2019 at $927 billion. But back then, the Fed still had interest rates at zero. So credit card rates were also a lot lower. As of the end of November, they hit an all-time record high. The average credit card interest rate is now 19.6%. That's the average. So obviously some people are paying higher than 20%. So we have near record debt, but we have record high interest rates. And of course, I'm sure that we have record debt by now because it doesn't count the debt from December. And that was when a lot of consumers had to buy Christmas presents or take vacations. And I'm sure the cost of a lot of that travel and those gifts were put on a credit card. So I'm sure we're at all-time record highs. In fact, sometime in 2023, I expect credit card debt to surpass $1 trillion. But what's also a big deal about this increase, and the year-over-year increase is 15%. That is the biggest year-over-year gain in credit card debt in 20 years. And in fact, if you look at total consumer credit, it's up 16.9%. And I think this is understating it because a lot of consumers have been taking advantage of buy now and pay later. And I don't even know if that counts as credit. I know that those buy now, pay later companies are not reporting to credit agencies the amount of money that their customers have committed to pay later. And in fact, if it wasn't for the proliferation of all these buy now and pay later companies, I'm sure credit card debt would already be a lot higher because a lot of the merchandise that was purchased using that gimmick would have been put on a credit card. And the irony of it is most of these buy now, pay later companies, when it comes time to paying later, you end up paying on your credit card. So all these buy now, pay later companies, when it's time for the consumer to pay, all those charges are going to end up on credit cards. There's just a delay between the time the consumer buys something and when the amount that he owes shows up on his credit card. The other really disturbing factor in the November credit numbers was that 46% of credit card holders now are carrying a balance every month. And that's up from 39% in the prior year. So that's a big jump in the number of people who have a balance. And that's significant because if you pay off your credit card every month, the interest rate is irrelevant because you don't get charged interest. In fact, you end up getting an interest-free loan from the credit card company. For example, I put a lot of stuff on my credit card. And a lot of people do that too because they get points or they get airline miles or cash back. There are a lot of reasons that people use credit cards to buy things, even though they have the cash. They just pay the bill in full when they get it. But if you look at how these billing cycles work, as long as you don't carry a balance, let's say I buy something today on my credit card. By the time I actually have to pay the bill, and maybe it's 6 or 7 weeks later that the bill is due, that includes that charge, there's no interest during that 6 or 7 weeks. So I get that loan. Now that loan is a lot more valuable today in a higher rate environment than it was when rates are at zero. But here's the problem for people who carry a balance. The minute you carry a balance on your card, meaning you didn't pay it off when it was due and there was some money left over, not only do you pay interest on the balance, but every time you charge something, you immediately pay interest on the money from the day you charge it. So in other words, if I'm carrying a balance on my credit card because I didn't pay it off in full, and I go and buy something tomorrow, and then I don't get a bill for 6 or 7 weeks, the first time I get my bill and I see that charge from 6 or 7 weeks ago, it's already got 6 or 7 weeks worth of interest tacked onto it. So even if I pay the bill in full at that moment, the interest is already there because it was assessed from the minute I charged something because I had a balance. But if you pay your balance off in full every month, then that never happens. But because we have more and more people who can no longer afford to do that, credit card interest is becoming even more problematic just at the moment in time where it's at an all-time record high. So the interest really piles up. And given the fact that interest rates on credit cards are now at record highs and more people are now incurring interest charges who weren't even incurring them in the past, but they've got them now because they can't afford to pay their bills off. They were able to afford to pay them off last year, maybe because they had some stimulus money that they used to pay off their credit card bills, but that well has run dry. And so more and more people are having to carry a balance, which means more and more people are having to pay interest. And when you're talking about 20% interest, that is an enormous additional cost. That doesn't even show up in the inflation rate because everybody who is forced to put something on a credit card because they can't afford it, whatever the price is, they're paying that plus 20% per year. So if you carry that balance for many years, think about that. After 4 or 5 years or so, you practically doubled the price that you paid because of all the interest that you've paid along the way. So the fact that credit card debt is skyrocketing as savings rates are plunging, this is very problematic for the economy. It shows that Americans are struggling to make ends meet. Not only do they have multiple jobs, you have moonlighting surging as people are taking second and third jobs, but even that's not enough. Even with multiple paychecks, they still can't pay the bills, so they are resorting to credit cards. But another important fact that nobody is talking about when it comes to credit is that credit is expanding, particularly consumer credit. It is growing at a near record pace. Now, when I talk about inflation on this podcast, I often talk about inflation as defined by an expansion of the money supply, which is what it is. But inflation is also an expansion of the supply of credit. In fact, a lot of the dictionaries that used to define inflation correctly defined it as an expansion of the supply of money and credit. Credit was a big part of the equation because people could use credit to buy things and bid up prices. And that, in fact, is what's happening. Consumers are dealing with rising prices, not so much by cutting back and buying less, although in some circumstances they are, but they're also taking advantage of credit so that they can keep on buying the same amount and just making up the difference by borrowing money. So the Federal Reserve is still keeping interest rates too low and allowing credit to grow too plentifully so that additional credit is available to consumers to continue to bid up higher prices. And so they're not being priced out of the markets because they're staying in the market because of their access to credit. So in other words, the inflation is continuing in the credit markets. What the Fed really needs to do with its rate hikes is raise rates significantly enough to cut off all that consumer credit. Credit card companies have to stop lending people money so those people will spend less and save more. But as long as credit is plentiful, available, and even though interest rates are 20%, apparently that's not discouraging the borrowers. What we need is for the lenders to wake up to the reality that a lot of the people who are borrowing this money are never going to pay it back. We need credit card companies to cut off these consumers because I think most consumers are going to keep on borrowing as long as the credit card companies are dumb enough to keep on lending. And one of the big moral hazards that nobody really talks about in the credit card industry is the more money that you owe on the credit card, once you've gone beyond the point where you know you can't pay it back. So you're already in so deep that you know you can never repay your debt and that eventually you're going to file for bankruptcy. Between now and then, well, the sky's the limit. Just run up as big a tab as you possibly can, because if you know at the end of the day you're filing bankruptcy and you're not going to pay for any of the stuff that you buy using your credit card, you are going to buy as much stuff on that credit card as you can before you file bankruptcy. So it's up to these credit card companies to take a look at how much debt their customers have already racked up and cut them off. Because once you know you're just playing with the house's money, if I have $50,000 in credit card debt and I'm going to default on it, well, why not run it up to $100,000 if I can? It's not going to hurt my future credit any worse to go bankrupt owing $100,000 than it will owing $50,000. So if I can still borrow the extra $50,000, I might as well do it, because after I file for bankruptcy, I can't do that anymore because now I've ruined my credit for a while. So I might as well buy as much as I can now, knowing that after I go bankrupt, I'm not going to be able to buy anything. And when you buy a bunch of stuff on a credit card and then don't pay for it because you declare bankruptcy, the credit card company doesn't take your stuff. Everything that you bought, you get to keep. And so there is a massive moral hazard there, because if you know you're not going to pay your credit card bill, you're basically getting stuff for nothing. Well, if you can get stuff for nothing, well, buy as much as you can. Why not buy it if it doesn't cost anything? The reason that people don't buy things is because they're too expensive. If everything was free, well, you would take whatever you can get. And that's what happens. In fact, that may be one of the reasons that we're seeing a lot of consumer spending. Even though the underlying economy is weak, the consumers are simply doing the smart thing because they have so much debt. They know they're never going to pay it back. They're going to go bankrupt, and they want to go out with a bang, and they want to buy as much as they can now. So this is not a sign of how strong the economy is, but how weak the economy is. It's not a sign of consumer strength. It's a sign of weakness, but it also proves that the consumers aren't idiots. They will take advantage of any opportunities they have, and that is exactly what they're doing when they're borrowing money that they know they're never going to have to repay and effectively getting stuff for free. And they don't look at it as a crime, because what they're doing is not illegal. And since it's not illegal, well, they figure they might as well do it. And if they don't do it, well, their friends are doing it. So why be the only honorable person? Because what are they going to get for taking the moral high ground? Nothing. And since no one who chooses the low road is going to be punished, when you come to that fork, the direction is obvious.